Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is Chief Investment Officer at the oil and natural gas hedge fund, Bison Interest, Josh Young. Thank you for joining me again.
Yeah, absolutely. Thanks for having me.
So, Josh, we're recording this on Friday, December 16th. Let me just talk about the oil prices right now. So the WTI crude oil price, which is not Texas Instruments, as that lady on CNBC said. That was one of the funniest gaffes I've seen in a long time. The WTI oil price is down substantially in the last couple months. It was 90 something a barrel only about 6 weeks ago. The narrative going around in the mainstream financial media, we just hear this phrase all the time, demand destruction. Is there concrete numbers, though, about demand destruction coming out of the European Union? Because that seems like where a lot of the demand, if there is demand destruction, that's where it's occurring.
Yeah, I think it's a good question. Honestly, there's not much. I'd say that the weakest spot relative to consensus has actually been U.S. diesel consumption has been a little weaker than people would have thought. But I think that's also sort of consistent with what we're seeing where online sales are down a little. I think the bigger story is more about this shift from goods to services consumption as a sort of post-COVID, sort of the COVID reopening trade. And I think people have jumped the gun a lot on sort of economic weakness because the companies that were the stars during COVID were the ones that were, selling you an exercise bike with an iPad attached to it and, selling you a service associated with that and pretending like they were a cloud business. So like that sort of thing was really the market caps of those sorts of businesses exploded higher. And the attention of sort of the market as well as of economic pundits was focused on those businesses. The reality is that the overall economy is very different. And, the US in particular is a very services-oriented economy. And so when we reopened, there's been this pretty big shift from, buying your second or third Peloton, which I don't own the stock. I don't own a Peloton. They're kind of fun, but to shifting to going out to eat, to traveling. And, you see it in the company information in terms of, the airlines are having blowout quarters, blowout years, guiding up, selling out, raising prices. And the online goods sellers and the cloud services businesses and other sort of supposed innovation stocks, those companies are doing quite poorly. And so diesel is a little more tied to that side of the economy, and gasoline's a little more tied to driving to a restaurant or going on a road trip.
Now, there actually is some demand, a substantial amount of demand destruction for natural gas demand out of the European Union, but a lot of that was probably, or at least a good chunk of it was because of the fertilizer producers that shut down, because fertilizer uses a lot of natural gas.
Yeah, that's right. Fertilizer, metals, so aluminum and other metal smelting and fabrication and manufacturing. Honestly, I think it's a really interesting story in terms of what's developing in the European Union. I don't think they can sustain their current low levels of consumption. Partly they're shifting. So this is a very, very bullish thing from an oil perspective. And even though European gas prices are considered very low versus where they were a few months ago, they're still 5 to 10x higher than they were 2 years ago. So still very, very high, to the point where it's economic to switch to oil products. Diesel is sort of on the expensive side, but if you switch to LPG or one of the other refined products that's a little less in demand, the economic spread is very, very wide. So we're seeing investment towards that. And we're also seeing factories that are temporarily shut off. I just don't think they can sustain at the current low consumption levels because too many people and too big a portion of their overall economies are driven by industries that they've forced off. So I think we need to see that something's going to break. I think there's a decent chance that European natural gas prices rise, and also that we see surprisingly large numbers for heating oil, which is essentially, it's very close to diesel, very high demand for other oil products that people can stick in power generators or heaters, or sort of heat generation mechanisms. And I think it's it's weird. Like everyone decided when it was a warm November that there was not going to be a winter and there was no energy crisis. And here we are, and weather just mean reverted, which is the tendency of weather. And they're sold out, or they're near sold out of heating oil in the UK, for example.
Yeah, almost on a daily basis, Josh, for the last 6 to 8 weeks, the politicians out of the European Union have been claiming they have plenty of natural gas for the winter. But if Europe has a cold winter, they're going to increase the usage of the heating oil and natural gas, even if the prices are high. I mean, people will trade down for maybe other things. They'll consume less. But if there's a very cold winter, I mean, you're going to still see people use the heat and electricity.
That's right. And also they're in the process of cutting down forests. They've been cutting down forests in Canada and not counting it towards emissions, because they cut them down in Canada and then burn the pellets in Germany and elsewhere. And obviously it's terrible for air pollution, like independent of climate. It's just terrible for people. It's terrible for the planet to do that. But now they're in the process of cutting down old growth forests to the extent that they exist, and replanted forests across Europe in order to use wood to keep houses warm as well. And so it's really, it's like terrible energy policy failure, but also it's so weird how people will in the eye of the storm. It's almost like picking up pennies or nickels ahead of a steamroller. Like you can see the steamroller, it's there, but just because it hasn't run you over yet doesn't mean that it's not coming. And it's a very, very strange, it feels like that across the hydrocarbon space. And it feels like just this inexorable rising demand and limited supply is just, it's coming to run us over. And people are in denial and they say, hey, it's not here, therefore it won't ever be here, and just ignore the evidence that it's coming.
And if there is a substantial drop in natural gas demand out of the European Union for, say, 6 months or 12 months, I think it's only going to be temporary, because we're seeing comments come out, whether it's politicians in Italy or other European Union countries, saying how they need to invest more in liquefied natural gas import terminals. They need to set up the facilities, the pipelines, so they don't get caught with their pants down, like what has happened in the European Union in the last 12 to 18 months, where they did not have supply, especially when there's oil and natural gas drilling bans. And one of the major sources of oil and natural gas in the European Union, the North Sea, the production is collapsing.
That's right. And they've been imposing, I mean, they're really like, it's astonishing how bad the policies have been. They imposed windfall profits taxes. And it's like, you want cyclicals to make money, so they reinvest. If they don't make money, they don't reinvest. And there are like bid rounds for drilling prospects and leases in the North Sea that are going unbid. And Norway actually, I think, banned the leasing of exploration prospects. So they're really going at it on both directions, sort of from a bad policy perspective. But this energy crisis, I think people forget, it was so poorly reported on. Like even the reporters who are now sort of renowned for, oh, you like predicted this thing, they only started reporting on it after it was already extreme. And it got extreme when a year ago, actually a little more than a year ago now, China in October, very early October of 21, put out an order to their utilities and to their energy distributors to go buy whatever they could on the energy spectrum, to ramp up their coal production and coal purchases, to ramp up their natural gas purchases, to ramp up oil purchases, just to buy. It was like essentially they wanted to clear the market and buy as much as they could. And that was the point where you saw like natural gas prices were 2 or 3 times higher than they were in the US. And that was already in the news. And that was where they went 10x from where they had been. And people forget that. They think this is a Russia war phenomenon, when it's really a shortage that's not really 100% related to Russia withholding supply. I mean, Russia's not helping, but there's this other bigger issue that's important because China is reopening right now. So China has not been a bidder. They've actually been a seller of contracted volumes of LNG as Europe has been refilling their inventories. Well, if China comes in and bids, if China had been in the market bidding the normal amount, Europe would not have been able to refill their inventories. Well, now if China starts bidding and getting some cargoes, then Europe may not be able to keep their inventories full, and Europe's inventories are quite small relative to their historic use. And even with their low use rate currently down 25, 30, something like that %, you're still, if you see China getting some LNG volumes, which they are starting to do, as you see that, you're going to see potentially a shortage in Europe even this winter. So it's important, I think, people treat these things as sort of two-dimensional, they're multidimensional, they're very complicated. And there is just this reality, which is there's insufficient supply that's connected to end markets. And there's really not the ability of the end consumers to reduce demand to the point that they've reduced it to and sustain it at that low level. So I think something breaks, and what breaks is that they're going to just resume consumption. And that's sort of the history of energy consumption, is it just gets added to, it almost never gets removed. And I think we just end up with much higher prices. And I think that does, from an oil perspective, which is where I'm more focused, I think there ends up being a really strong bid for oil and oil products for things that people have been using natural gas in Europe and Asia and various other geographies where they've been importing LNG. And I think it's just something people, they still don't want to talk about it. It's hard to find reports that calculate it or track it. And you can just see the economic spread, which tells you that economically focused utilities, economically focused industrial participants are seeing this, and they're very likely to switch over some amount of time.
So before we talk about China reopening as a potential demand driver for oil and natural gas consumption, I want to ask you about the supply side with Norway. So you talked about some restrictions with Norway and other European Union countries. Norway was actually one of the few countries that was increasing liquefied natural gas exports to the European Union. Maybe they benefited from the Nord Stream 1 and 2 pipeline coming offline. They were increasing oil and natural gas wells. Now, maybe with their sovereign wealth fund, they weren't buying oil shares. But isn't Russia's oil production also declining too? So there is clear supply side problems if China were to reopen and demand were to start to get to somewhat normal levels from, say, 2 years ago?
Yes.
Oh, could you talk about a little bit more of the detail then for some of the Russian oil production? And we've been covering this also in past interviews, Josh, with OPEC and OPEC Plus. I mean, the numbers coming out of OPEC and OPEC Plus, without them announcing additional production cuts, the numbers are falling off a cliff. Their production numbers, it seems like, to use like a car engine quote, they were running past the red line there on maximum on the engine for oil production, and now their production starting to slip on its own naturally.
Absolutely. There's been underinvestment. OPEC has been investing a lot recently in development. And so over the next few years, I actually expect OPEC to rebuild a portion of its spare capacity and to actually increase its sort of baseline production capacity and production, let's say over the time frame they've shared. So by 2027, I think we should be pretty good for another maybe couple million barrels a day from OPEC in aggregate. And that's probably 3 million barrels a day added between Saudi Arabia and UAE and a few others. And then some lost in West Africa and a few other jurisdictions that are under investing still. So it's not that I'm a bear on, or that I believe that OPEC can't produce more eventually. It's that, tracking the capital expenditures that they had engaged in, along with their historic peak production levels versus inventories, it was clear that there wasn't the spare capacity that they were and have been representing. But again, that's a static measure, and things are changing there. But in the same way that they're changing there to the positive, but with, let's say, a multi-year lag, you look at NOPEC, which Cornerstone and some others talk about and focus on. There are some of the same dynamics in various non-OPEC international jurisdictions, outside of North America, that are very interesting and very troubling from an oil supply perspective. So yeah, I think there's there are challenges sort of across the board. Just from a world perspective, there's been massive underinvestment in oil and other commodities over the last almost 10 years. And I think we're going to enter a massive CapEx cycle to make up for that. It's sort of almost like biblical, like 7 lean years, 7 fat years. So it's going to be fat years for the producers and lean years for the consumers, because there's just been such significant underinvestment. When you look at Russia, historically, Russia has actually had significant production capacity, and Russia's had a lot of success. I mean, some of their fields were very poorly developed by the Soviet Union, and in the sort of post-Soviet era, there was a a lot of bad development for the first, let's say, 5 to maybe 10 years after. Just there were a lot of problems with governance and a lot of sort of weird, very short-term oriented approaches towards development and field management. After that, though, once I guess Putin was sort of firmly established and had sort of reallocated ownership to various Kremlin-friendly companies and oligarchs and so on, those guys have pretty effectively managed their fields and their development. And Russia, of all of the OPEC plus countries, has probably done the best job, maybe them in UAE, in terms of sustaining their production capacity. The problem there is related to sanctions with the EU, because Russia invaded Ukraine and is under significant sanctions. And even if you assume that these price caps don't work that have been supposedly implemented, and that sanctions don't work on the oil exports and import bans don't work in the EU, even if you assume all of that doesn't really work, you're still going to see declines in Russian production as some of their technically complex fields that required the brilliant engineers and scientists at Halliburton and Schlumberger and Baker Hughes and so on, now that those people aren't in country anymore, and their equipment's gone in many cases, and the technology isn't really available, and Russian companies are switching over to far inferior services companies based in other jurisdictions with inferior technology. And the people, I'm sure, are wonderful, but just don't have the same degree of expertise, typically not the same compensation, typically not, they're just not they're not the A team. So in that context, Russian production should fall quite a bit. And it's just the challenge is in forecasting from that sort of factor, timing. So is it a year from when those sanctions came on? So a year from, let's say, March or April of this year? Is it 6 months, which I think a lot of people thought, and that hasn't worked out so well? Is it 18 months? It's sort of hard to tell, but you have this trajectory that's likely, where you're likely to see 1 to maybe 2 million barrels a day offline relative to where Russia was producing and exporting in February of this year, by, let's say, next March to maybe next June.
So in the last couple of weeks, we've seen some really interesting headlines from the Saudis that they're actually discounting oil that they sell to China. Why do you think the Saudis would need to discount some of their oil to sell to China?
I don't think they need to. I think it's an interesting question in terms of how the Saudis are navigating this and how OPEC and OPEC Plus are navigating this. I think the assumption that I made in my last comment on Russia was that price caps and sanctions and purchase bans from Europe have no impact. And the reality is, so that's my baseline understanding and just what I'm going to assume, because I'd rather be surprised by more demand than surprised by less demand. I'd rather be surprised by less supply than surprised by more. But a most likely scenario is that there's some disruption in crude flows, and that Russia is stuck with, let's say, a certain amount of production, maybe it's 500,000 barrels a day or so, that they're not able to export and sell. And in that scenario, which again is like reasonably likely, but is not my base case, in that scenario, China and others are going to need that Saudi production. And Saudi doesn't necessarily do that much better by having a higher than benchmark price. They do better by just having the benchmark be a high price. So their OSP being $6 over Brent or whatever a few months ago versus now it being, I think, $2 over or roughly in line. I don't think that really matters so much. It's not like they're flooding the market. I think they're probably seeing what I'm seeing, and they're probably actually just talking to their counterparts in Russia to get an accurate picture of it. But I think there's just an expectation within OPEC and OPEC Plus that there will be fewer Russian barrels on the market. And I think that's partly why they didn't cut again, even though oil prices pulled back recently in their recent meeting. And, I think if that's wrong, I would expect OPEC to cut, especially if oil prices were to fall, let's say, sustainably below $70 a barrel WTI. I would expect them. And I know they track Brent, but still, like, realistically, with a few dollar spread, that would be sort of under 75 Brent for a period of time. If that were to happen, I think they would cut, especially if Russian barrels end up continuing coming to market.
Do you see the main demand driver in the near term to create a rally for oil prices as China reopening their economy from their zero COVID policy and actually allowing normal economic activity again?
Yeah, I mean, they're doing it. And I think the noteworthy thing is that Chinese politicians today, Chinese autocrats, sound like Republican politicians 2 years ago. And so that's noteworthy because subsequent to Republican politicians 2 years ago sounding like this, there were massive COVID waves and they stuck to their guns. And frankly, it was the right policy on a cost-adjusted basis. It was a right policy even from an epidemiological basis, like not more people die when you deny them freedom of mobility and access to healthcare and so on. And so, I think this is the right policy. And they're already in the process of reopening. I've been tracking and actually recently posting daily updates on China to China flights, which are up over 100% in the last week. Or last 2 weeks. It's really remarkable. So a huge increase in flights. Flights are a great leading indicator for overall economic or broad economy consumption of oil and across a variety of uses. And, just purely from those flights, it looks like there's at least 200,000 barrels a day of incremental jet fuel demand, which actually is pretty oil intensive to get jet fuel. So it's great to see. It's wonderful for the Chinese people who have been unfortunately locked down for years intermittently. And again, with what they're saying and how they're shifting publicly from a leadership perspective, it doesn't look like they're going back. So even as there's these big waves and there's newspaper articles that are really scary, frankly, we experienced this, right? Like we saw Republican politicians in Republican states saying these sorts of things. We saw really scary news headlines and we saw what actually happened. And what happened is they just kept their states open and there wasn't this sort of mass extinction level event that Democratic politicians as well as some epidemiologists warned of. And I don't see why this is likely to be substantially different. If anything, the one benefit that there is just the rule for these sorts of things over time is that they get that diseases get more contagious and less deadly. And so the benefit of having been locked down, there are many, many detriments, but one benefit is that whatever this is that everyone's getting is likely a less deadly and more contagious variant. So everyone gets sick, everyone's sick for a week or two. Some people die, but the reality is some people die no matter what. And the economy reopens and actually probably the mortality rate goes down over time because not physically locking people in their apartment complexes is a better policy, including health policy.
Here in the US, now that the November congressional elections are over and the Republicans won back more seats in the Senate and the House of Representatives, do you expect that the strategic petroleum reserve dumping that the Biden administration did is either ending or over going forward?
I was shocked today when they announced that they were buying some oil for the SPR. I was convinced they were not going to do it. So I probably shouldn't comment further on that because I was just, I thought the whole policy was dumb. I thought they were just, sort of dumping the SPR to get votes, which I still think. And them buying back oil for the SPR was surprising to me. I don't know what they'll do. Obviously, to the extent that they do refill the SPR, it's very supportive for the oil market, at least in the short run. I don't know. And, I think it's okay because my base case is sort of like how I was underwriting Russia and describing it. My base case is the sort of most bearish case for the oil market. And if they continue to do this and buy back a bunch more oil, that's just sort of good for me and for my bullish oil call and my oil and gas equity investments. So
it's a national security issue, and it was being used to try to knock gasoline prices down to help influence Democrats in the election. So didn't the Strategic Petroleum Reserve, it went from around 700 million barrels down to around 350 million. So it was almost halved in a very short amount of time.
Yeah. And again, I think that, like I was saying, the motivations were not good and they were transparent. And and this started ahead of Russia's invasion of Ukraine. This was not, it was just sized up after the invasion, but this was not war driven. This was not strategic. This was, the joke was sort of, it was the midterm petroleum reserve that was dumped in order to secure, there was a better result for the ruling party in the US than was expected or than was showing in the polls. And it seems like the single largest factor for that was this dumping of the SPR. That being said, there is an argument, and I will raise this. I do try really hard to understand bearish aspects and other sort of explanations in the oil market. I just don't often talk that much about them because I feel like they get a lot of airtime just because of the negative sentiment in the space. But I will talk about this one for a minute. There is an argument that we need less oil in the SPR because we produce a higher percentage of the oil that we use than we did in many years. So I'm a little sympathetic to that. The flip side is I'm also very worried that having depleted the SPR as much as we have, that we're getting to a point where remaining reserves that in the SPR are not conducive to our domestic refiners, and that there may be some contamination. There have been significant reports of contamination and issues on previous SPR sales prior to the last year or so. And, I have trouble believing that those were one-off and that somehow we fixed that problem and all of the oil in the SPR is available. And to the extent that that's a real concern, it's a particular strategic issue to be depleting the reserves, even if we have a higher percentage of our sort of domestic consumption covered by domestic production.
But a lot of the U.S. oil production, and if it ends up at a U.S. oil refiner, the oil refiners here in the United States, the Gulf ones, aren't they shipping enormous amounts of diesel and gasoline out of the United States because the profits are higher to ship it outside the United States and there's no export ban?
Yes. But again, I don't think that's sort of that's not... A lot of that is honestly a different problem, which is the Jones Act. So we don't have the right pipeline infrastructure to get the right refined product mixes to the right places, similar to natural gas. I mean, some of this is Jones Act, some of this is NIMBYism around pipelines, where New York State won't allow pipelines, or the Mountain Valley Pipeline, they just keep killing it or not allowing this permit underneath a stream, even though they sort of already dug it. They just need to put the pipe in and start running it. But that sort of NIMBYism is preventing the reasonable commercial flow of interstate the flow between states of hydrocarbons that are being consumed in various states, again, that just aren't adequately served by existing pipelines. So a lot of those exports is just sort of a weird thing where you end up with, let's say, diesel exported from the Houston Ship Channel to, I don't know, somewhere in South America, and then somewhere in South America exporting diesel or from some other refining hub exporting diesel to the US, to the Northeast. Or like the craziest thing is actually not on the diesel side, it's on the natural gas side, where Boston imports liquefied natural gas. They're 100, 200 miles away from the Marcellus, like one of the largest gas discoveries in the last 2 decades that we're producing, and that generates a lot of U.S. economic activity and a lot of jobs. And I mean, it's just this wonderful benefit that the U.S. has. And instead of getting Marcellus gas that could be easily and safely shipped via pipeline over a short distance, gas is being produced in, let's say, Qatar and frozen and then shipped thousands of miles to...
Inefficient and wasteful, and overpriced. Yeah, Doomberg has been, I don't know if you follow their work, Doomberg has been covering this for over 12 months.
Yeah. I mean, like, it's been the thing for a few years, and I've whined about it. Doomberg has a number of people. It's asinine. I would say that that's the bigger problem, rather than there's not really a refinery shortage. There's no real shortage of natural gas in North America. We actually have a surplus. It's wonderful. And we will likely have one for a while if natural gas prices stay as high as they are right now. So, I mean, it's just a shame. But that's more of a political thing. From a supply demand perspective and from an SPR release perspective, the SPR is is necessary in some size, and what's remaining, it's hard to have confidence that it's sufficient if the US were to enter a war. So people will say, oh, well, there's a war in Ukraine, therefore we should sell our SPR oil. And the reality is we're not using more oil right now, and our supplies weren't really affected by that war. And it's obviously tragic for Ukrainians, but that's not the circumstance that the US SPR was created for. And it certainly wasn't created to facilitate the re-election of whatever political party is in power at the time.
So as we wrap up the interview, I want to ask you about production costs, profit margins, and free cash flow for some of these US and Canadian oil and natural gas producers and their hedging programs, potential dividend cuts if oil and natural gas prices go lower. Let's talk about some of these lower cost producers that maybe have a hedging program like a Sandridge Energy, which you have tweeted about in the past, talking about their hedging program. Are a lot of these US and Canadian oil and natural gas producers, are they hedged at $90 a barrel oil and at a good, healthy natural gas price above their production costs?
Great question. There's a variety of producers with different hedging programs in place. Typically, producers actually have very low price hedges that were put on in, let's say, 2020. Hedging, unfortunately, is often a sort of knee-jerk reaction to prices falling. I tweeted out this picture that I'm blanking on the name, but these guys, they put out great charts. So they put out this picture where it's at $120 oil, everyone was lining up to buy oil, and at 70, no one was. So producers they're not different, right? They're subject to the same sort of emotional and financial biases that everyone else is. And they go, and when prices fall, they go and they lock in low prices. And then when prices rise, they make much less money than they should because they locked in low prices. So generally, hedging has actually been a negative activity for the industry because it's emotionally driven. Dividends, buybacks are also very similar. I mean, there's companies in Canada, for example, that are paying a higher dividend than their current free cash flow at current prices. And, I think oil prices will rise over time, but I don't know what oil prices will be next week or next month. And if I were a producer and I were paying a dividend that was over 100% of my free cash flow, I mean, that's a tough situation. And then in terms of low cost versus high cost, there's a lot of complexity in that. So you mentioned Sandridge, which I own and I'm not recommending. Sandridge is not a low cost producer. It's actually a high operating cost producer, but it has a very low production decline rate. So it's a high cost producer versus, because a lot of their wells are old and because they have to dispose of water that gets produced along with their oil and natural gas, it costs them more per barrel of oil equivalent to produce oil, but their decline rate they disclosed is only 8%. So their production in aggregate across their company declines by 8% a year if they don't reinvest. Whereas let's pick on a Devon Energy, which is sort of well-known and lots of people like them, big S&P 500 stock. Devon, I think their corporate decline rate is 25 or 30 or something percent, somewhere like that. And so with that sort of high decline rate, they have to go reinvest in order to be able to make up for the 25 or 30% of their production that declines every year, or that essentially goes away every year. And so Sandridge is advantaged relative to most of its competitors that have this high decline rate and are required to reinvest more. So, but they're technically a high cost producer from a production cost perspective. They're just a low reinvestment requirement producer in order to keep their production flat. So all in all, they're actually very well positioned from what I can tell. But I think it's worth clarifying that because there's a lot of complexity. I think people try to boil down these companies into very sort of simple heuristics. And the reality is that you sort of, as an equity analyst and portfolio manager, I have to consider a whole matrix of different considerations for every company. And there isn't really one or two good metrics to use that tell you, in my opinion, if a company is likely to outperform over time or not, or if a stock is likely to go up more than its peers or not.
Yeah, that's a good point about the hedging programs. I mean, I cover mining stocks too, and I see that all the time where the hedges, I think with Agnico Eagle Mining, which is a gold miner, they put in some bad hedges on currency transactions and in bad hedges on diesel, and they lost $150 million in write-downs. So the hedging programs, people like, oh, are they hedged? They act like it's always a good thing. And in reality, I mean, a lot of these mining company CEOs and their executive staff, they lose a lot of money on their hedging programs. I think, didn't ExxonMobil have like a trading unit, a large trading unit for oil and natural gas, and they were losing money at some point for a certain period of time while they were trying to do a bunch of sophisticated trades.
Yeah, well, that's one of you and I have talked offline about different sort of media issues. And I remember years ago, I was sitting at a conference. This was shortly after Exxon had ramped up their trading business, and they were presenting at the lunch at the conference. And I was sitting there eating, and they casually mentioned mid-sentence something about a multi-billion-dollar trading loss. But they couched it in a way where, I know it sounds ridiculous, right? But they said it in a way where if you honestly, I wasn't paying that much attention to what they were saying. I just didn't. They were talking about their refining and marketing group. And this was, I think, in 2017 or 2018, something like that, probably 2018. And it wasn't a relevant consideration for the things I was looking at. And so it actually helped, I think, that I wasn't trying to follow what he was saying too closely, because I heard it and I was like, I think he just said this thing. And I looked at their statements and they sort of hit it. But you could tell that they were actually offsides on this pretty big move that had happened in oil, I think it was at the time. And so I chatted with a reporter about it, and I was all excited because I had very, very little coverage on what I was doing at the time. And they wrote about it and they didn't quote me. And they didn't like say that it wasn't their idea or whatever. No one noticed, no one knew. And then, of course, after it was covered in a major media publication, then suddenly, there was lots of coverage on this thing. And now everyone knows that they're doing it and they talk about it a lot more. But this was literally, it was like a footnote in their 10K. And it was something that they were trying to sneak into random presentations just to have been able to say that they told you so. And I guess got lucky to some extent in terms of noticing that it was happening. So I figured but yeah.
The lawyers make them disclose it, but they choose where to disclose it. So normally it's in like size 6 font or something like that in a footnote.
Yeah. One of my friends likes to joke that people will do anything to avoid reading a 10K. And honestly, I've done very well through just being diligent and finding all this information. And it really, I think it bothers me a lot when people, and obviously people can do sort of whatever they want, right? If they want to go buy a stock that's grossly overvalued and contribute to, promoting that they have some giant fine in some place or whatever, great, more power to them. They have freedom of speech and they have freedom to lose their money. But it is remarkable to me how many people will line up in that sort of equivalent of that $120 oil buy line, and how few people will go and do the work. And I mean, it's a lot of work. It's hard, but it's doable. And you can sort of pick your own destiny by being the person that reads that footnote in the size 6 font, or the person who just, buys the thing that, you heard about at a cocktail party and does no diligence on. So yeah, I think it's if anything, the thing I can do best now that I have some amount of following and platform, whatever, is just encouraging people to do their own diligence. And diligence doesn't mean listening to a podcast. This is wonderful. You provide great information and it's fun to get to show up on podcasts like this, but really people there's information out there that's available to a reasonably well-educated non-professional. And I think it's totally within everyone's purview. And I think it's a reasonable expectation that people will go and actually do their own diligence and read these things.
Oh, yeah. If they're just listening to a couple podcasts and then going out and buying, especially with Vancouver junior mining stocks, they actually prey on a lot of people that listen. The more podcasts people listen to, the more these junior mining stocks out of Vancouver advertise, and they just pump these garbage shares. A lot of these companies, if you actually spent the time doing due diligence, you wouldn't put any money into any of these. But I get emails all the time from people who listen to more and more podcasts, and then they buy whatever's marketed on the podcast, and it just scratching my head you've fallen prey to bad marketing.
Yeah, well, frankly, that was the whole thing with the crypto thing, right? You had whole media businesses oriented around
celebrities too. I mean, look at the long list of celebrities, but now finding out they were paid, they didn't know what they were talking about, and now they're all being sued in class action, right? So
the lack of disclosure there too it's really astonishing. And I think that's happening I mean, I'm starting to see it in oil and gas. I wrote an article recently about one where there's just very weird activity. People that are super excited about a discovery in a high cost jurisdiction that hasn't proven economics, and where there's just a bizarre amount of excitement around a frontier jurisdiction that is known to be high cost, where the locals are pretty negative on it. And it's hard to find anyone that actually is in the business of investing in oil and gas public equities who's excited about it. And I don't know, it's just very, very weird and disconcerting. And honestly, like, I probably should just talk about this stuff less, because I end up getting a lot of like intense negative feedback, and life's too short. But it's been fun, at least on a couple of these things, to be able to encourage diligence, encourage people to not just take a picture of a well site or whatever it is and get excited and gamble their money away. But yeah, real weird, really unfortunate. And I think just if people just read the documents and better understood what they were reading, and I think there's, if you're not going to do that level of diligence, again, not becoming a geologist or engineer, just reading financial statements and disclosures and actually reading through maybe what competitors say in addition to what the company that you're looking at. If you're not going to do that, like, it's probably a better idea just to, obviously you want to have an advisor, and you want to probably just not try to be an active stock picker.
Yeah, don't go in. But if you're not going to do extra research or pay for a newsletter writer who's going to read the financial statements and go through all the work for you, then buying individual stocks, very, very risky. I mean, look at all the fraud headlines. Now that the interest rates are going up, we're seeing all these frauds come out because the companies can't raise easy capital out of Silicon Valley, and you're seeing all these frauds exposed with the higher interest rates.
I have the You Can Be a Stock Market Genius Even If You're Not Too Smart book on my bookshelf. I was just looking for it. And that was written by Joel Greenblatt, who has one of the best track records out there. He ran a fund for a decade that compounded at 50%. I think it was 50% net of fees for a decade. And he's famous for this quote. He says that investing in stocks without knowing what you're doing is like running through a dynamite factory with a lit match. You might not blow up, but you're still an idiot.
Yeah, you're juggling dynamite. You're playing with fire. It's just not very smart. And now
playing with fire in a dynamite factory.
Well, a lot of people just look at charts, but I mean, like, charts don't expose the fraud right away. So
yeah, and not that I'm even saying that I don't know, like, maybe there's a lot of fraud, maybe there isn't, but I'm just like, I think it's just remarkable, right? Like, you could have owned at that time Exxon and just owned it because you're like, hey, this is a dividend aristocrat. It's raised its dividend forever. And like, I'm actually like an Exxon fan. I don't own the stock, but I think they're navigating things quite well. I've written articles about them and Chevron and how they're doing way better than their peers in terms of navigating these crazy ESG pressures. But you could have owned it at the time and not understood that they were about to have this giant miss, and they had the miss and the stock got crushed. So, or you just read that and avoid the pain. And, unfortunately, many things aren't available in the footnotes, but it's sort of painful to see that in there and just know that almost no one's going to find it, and or vice versa, right? Like, I own Journey, which I think you and I have talked about before, and they have a power business, and everyone looks at them and they're like, oh, it's a small cap E&P. Like, who cares, right? The stock's done really well. The valuation looks low, but so what? But you read the financials and you look at them and you're like, wait a second, their highest cost is the abnormal cost for them is power, because power in Alberta is really expensive because it's undersupplied. And they're building a bunch of power plants local to them, small scale. They're buying them used, but they're working really well. So their capital cost is low. Their OPEX improvement is high. So they're cutting their OPEX dramatically. And the value, that wedge of cut OPEX, I mean, it's valuable for their business, but it's also, you can account for it either as lower OPEX, or you can account for it as cash flow in a integrated power gen business. And as they ramp it, that goes to scale, and you go from 2 or 3 or whatever, probably 2 times cash flow at current prices business to a power gen business that's, as an integrated business, it's arguably worth 10 plus times EBITDA. I mean, maybe more, because it's inflation linked. And the cash flow is likely to grow over time because of the underinvestment trends for power. So, and I own the stock. I'm not recommending it. I just like, you can hear about it, or you can look at the financials, read their footnotes, and be like, oh my God, they have this. It's almost like a value investment, like good co, bad co framework, where the bad co is the E&P, which should maybe arguably have a low multiple or lower, and they have this rapidly growing, fantastic business. And the power gen side. And if you don't read the financials and read their disclosures, you can sort of miss it. But I mean, I think in 3 years, there's going to be this just enormous value that will built out from this thing, maybe worth more than their entire market cap. And it's there, it's in writing, it's in their financials, it's in their management discussion and analysis section, which is a filing that Canadian companies do quarterly. And just people, they don't care, they ignore it. They sort of like look at it relative to other producers that don't have a rapidly growing power business. And it's like, well, these are not the same things. So yeah, I think I think if there's one thing I do in life and get people to do more work ahead of making investments and to understand the value of diligence, that will have been a great contribution to the world.
So I have one more question before I let you go. Are costs to drill new oil and natural gas wells, these oil service companies, the Schlumberger, I think in Q2 was deeply cash flow negative, and they were still paying out a dividend. They were going to have to hike prices because they had oil service prices so low for so long in 2020, 2021. And they were still paying out their dividend and their cash flow negative. Do you expect then the industry, oil and natural gas wells, the costs, the drilling costs, all the labor supply, all these things to keep rising then going forward?
Yes. And, one thing in common across a number of the companies that I've publicly disclosed owning is that they are very low decline rate businesses. So Sandridge disclosed that they're declining at 8% a year before CapEx. Journey is declining by about 12% a year before CapEx. The industry average for onshore North America is close to 25 or 30%. There are businesses that people love and aggressively tout that have 40 or 50% decline rates. So the higher the decline rate, the higher the reinvestment requirement, the more exposure to cost inflation in oil and gas services for drilling and completions and other sorts of related services. And I think actually oil services is one of the few, I wouldn't call it a sure thing, but it's pretty close, because you kind of can't have an end to this current commodity cycle for oil and natural gas unless you have a lot more capital spent. And you're not going to have more capital spent unless you have the cost of capital for these oilfield services businesses fall a lot, such that they're able to more easily afford reinvesting in new equipment and services. And it's sort of a logical step where you need more investment so you can have more supply, so you can have lower prices. Until you have that, sure, you can have an economic downturn and temporarily suppress commodity prices. But, I guess also assuming that demand rises, which it has almost every year for the last 40 years, and really since oil has been used as an energy source, and frankly, for almost all energy sources, since they've been used as energy sources, they only increase until we run out of them. That's just sort of how we behave as humans and as societies. So as oil demand continues to grow, you just need more investment and more consumption of oil field services, which means there's going to be higher prices, and it means there's going to be better margins. And those stocks, it's a pain trade. They are going to go higher over time. They have to the extent that oil consumption rises, because they are the key to higher oil production. So, and the way I express that is both through owning oilfield services stocks and through owning low decline producers like Journey and Sandridge that are so low decline that even if services costs go up a lot, it's just going to force the commodity prices up. And low decline producers actually are net winners because, they spend more to drill, but their low decline production totally wins versus high decline production. So I think there's different ways to play the same thing. But I think the services businesses are very, very well situated. I don't personally own or professionally own, specifically Schlumberger, but that whole set, I think Schlumberger should do well. The other big oil field services businesses should do well, and some of the smaller ones should do even better.
Yeah, Schlumberger trades at a higher valuation than a lot of the smaller and mid-cap oil service stocks because they're more liquid. So a lot of the high-frequency trading algorithms, the larger funds, just buy that one for oil and oil services exposure. But they had a highly leveraged balance sheet. They were using debt, I believe, to pay the dividend while they're cash flow negative. So that's not sustainable to keep loading the balance sheet with debt to pay off a dividend. So at some point, they're either going to have to raise prices to improve their profit margins and their cash flow, or they're going to have to cut their dividend.
Yeah, I mean, again, I don't own it, but I'm not worried.
I'm just talking about like for investors out there who don't understand financial statements and how the business operates. So it's not sustainable then for the company to keep loading the balance sheet with debt and maintaining the dividend. So our last question here before I let you go, are we around the levels where you expect to see dividend cuts then for some of these producers? Or do you think the oil price, the Brent and the WTI oil price need to go, I don't know, $5, $10, $15 a barrel lower? Or do you think that we might start to see companies talk about dividend cuts then?
So I really dislike variable dividends because companies that impose fixed dividends on themselves generally are conservative. Again, there are a few exceptions that I was talking about earlier, but variable dividend payers are very likely to cut their dividends because they're just making less money. So if they're paying out a certain percentage, that percentage will inherently be smaller because it's a percent. If they keep let's say 75%, but the amount that they earned is half as much because the commodity price is down 40%, their dividend is going to be lower. And we're starting to see some of that get priced into those stocks. So I think that's very likely. But the flip side is, so that's on the producer side. On the services side, services costs are rising and services margins are widening. So I would be more worried about that for a variable dividend paying producer than I would for a services business that was paying a dividend here. And then on the fixed dividend side, I think there are some producers. So some of the Canadian guys, especially the heavy tilted producers, that are, and some of them are paying pretty aggressive dividends. Those absent oil prices rising a lot because of the high differential for Canadian heavy oil, which again, I don't think that's permanent, but to the extent that what's happening right now continues for the short term, those dividends are unsustainable and may need to get cut. And unfortunately, historically, I've been there for dividend cuts in certain stocks, and it's been very, very ugly. So I think we're already at the point where that could happen. And I'm not wishing it on anyone. Frankly, I think it's likely that oil prices rise and that this sort of works itself out. But it does seem like some producers got ahead of themselves, like you're describing. Again, I think Schlumberger probably is fine, but some of the producers, I think, got ahead of themselves, either paying too high a percent of their cash flow in variable distributions or just paying too high of a fixed dividend. And but both of those, I think there might be some more pain ahead for some of those equities.
And for our listeners out there who are not familiar, when Josh said 75%, he meant 75% of their free cash flow. So they announced a variable dividend policy where they're paying out 60-70% of their free cash flow in dividends. That was For example, right. So like if it's over 50%, that's sort of where you get into the problem area where it can get really uncomfortable if your cash flow falls as much as commodity prices have fallen from Q2 to Q4. So that's sort of the uncomfortable zone. For producers that are guiding to a minimum of 25%, let's say, of their free cash flow as a dividend or variable dividend, and we're paying that, I think those guys are much better situated to be able to just pay, if they want, a higher percentage of their free cash flow and be able to sort of sustain their dividend. So I think generally, like, any pain that's felt on this should in theory be somewhat short term. The flip side is that some producer equities traded to meaningful premiums versus their peers because they were paying such high dividends, and it does take a while to regain a equity cost of capital from a dividend if you cut a dividend and then reinstate it. Yeah, and then you also have pension funds and mutual funds that may have bought an oil and natural gas producer solely because of the dividend, and then they will unload positions with dividend cuts. So that's going to be painful to work through for some of these shares.
Yeah, exactly. But again, like, I think medium to long term shouldn't be an issue. Short to medium term, there are some producers in particular that may be at risk. And, again, just do your own diligence. And if it's hard to figure out if a company that's paying a high dividend may or may not have a problem, the higher the dividend yield, the more likely it is that there is a problem, just as a heuristic. It doesn't always work, but more often than not, high dividend yields are a way of the market pricing in the probability of a cut. The problem is that it's never fully priced in. So when you actually have a dividend cut, in many cases, you see the stock prices fall even more.
Yeah, I totally agree. And then also in this environment which is basically anti-fossil fuels, pro-ESG, politicians in other countries, even in the US, but more so in other countries, threatening to go after oil and natural gas companies. They see the dividend yield on some of these companies like a Petrobras, and they're talking about windfall profits taxes. So you're in a difficult environment where I think Petrobras was paying out over 60% of their free cash flow, and they're paying out over a 20% dividend yield. I mean, that's a target for politicians and regulators when the average working class person in Brazil is paying an enormous sum of money monthly for diesel and gasoline.
Yeah. So, I mentioned OPEC earlier. So Petrobras is a great example. Brazil, they always guide to production growth and they almost never achieve it. Like you look at the guides to production growth for Brazil over the last decade. I think Paul Sankey and Cornerstone and others have talked about this publicly. Like it's pretty rough. So no surprise there. Governance has been challenged. There's been lots of corruption and other issues. It seems like the election is being challenged there. There have been giant protests and some violence, unfortunately, and some arrests and other issues. And there are very, very different economic visions from the two candidates or people that are trying to be president of Brazil. And so, yeah, it's a mess. And that mess, unfortunately, is true across a number of different jurisdictions that people were hoping would be sources of incremental oil and gas production. And what's bad for them is great for oil and gas producers that are not in those jurisdictions. So geopolitical risk is real, and it's real in Europe, and it's real in Brazil, and it's real in a number of jurisdictions, including the US and Canada. And I think it's just important to understand when there are risks and to face them head on and not ignore them.
Well, Josh, I want to thank you so much for your time. You are truly a wealth of information for oil and natural gas and other energy markets. We didn't talk about nuclear power. I'd like to see more investments into nuclear power. We're not seeing that yet, although Germany and France and Japan may restart their nuclear power if they want cheaper electricity. My listeners want to take a look at your research, follow you on Twitter. I also highly recommend signing up for your email news list because you provide a lot of great information for free about the oil and natural gas markets over at Bison Interest. How do they do so?
Great. Yeah, just bisoninterest.com. I think we just started a Substack for people that want to get our research, but who aren't, we essentially have our clients in sort of one list and prospective clients and so on. And then we're happy to share our insights publicly for free. And so we started a Substack. So we started when people sign up on our website. I think from now on, most are going to be directed into this free Substack where they'll get our monthly newsletters. But the best way to do that is just go to bisoninterest.com, check out our content. I'm on Twitter, probably too active, Josh_Young_1. And then our Bison account's much less active, but Bison Interests on Twitter puts out our research and is pretty good as a sort of reasonable energy industry follow.
Yeah, Josh also tweets about a lot of Texas barbecue and grilling meat. So Josh is an expert at that.
Thanks a lot. Have a great weekend. Thank you for having me on.